My favorite account is the superhero account. It's not a real account. It's just a nickname for a brokerage account. So yes, it's a very real account, but some people call it a joint account or individual account or after tax or brokerage account. I call it a superhero account because what I'm about to show you in this case study, I think is going to blow your mind. It blew my mind the first time I was running the projection with a client. So check this out. These are their ages. So 55, 49, a 21-year-old child. And most people that reach out to us, the majority of their money is in a 401k. So you can see here, they have 1.9 million in a 401k, 61,000 in a Roth IRA. So most of their money, they got a deduction when they put money in, it grows tax deferred, and then when you take the money out, you pay ordinary income taxes. But this superhero account is such a powerful thing that most people overlook. And there's a lot of people that are what are called house rich, cash poor. That's my parents. They own a beautiful home worth a lot of money, but they don't want to sell it. So it's not creating income for them. They just love it. The difference is a lot of you are not house rich, cash poor. You're qualified rich, cash poor. I know it's another phrase I made up, but I do these silly phrases so that you guys can finally connect the dots. So you can see here, that's what they are. The 1.9 million, that's all traditional 401k, which means if they were to say, Ari, I have $1.9 million, I'd say, no, you don't. I don't know how much you have after taxes, but it's probably more like 1.6, 1.7 if we're lucky and we're doing good planning, because we have to think about how much in taxes we're paying every single year. And they're like, oh, so I should have got that brokerage account earlier. And I'll show them the impact of that. And that's what I'm going to show you in today's video. And I'm really excited. I get so excited about this stuff because the tweaks that I might recommend to a client are so easy on your end to do. For example, many of you are like, I've got to save to my 401k. I've got to max it out. I've been doing that since my 20s and 30s. That's where I learned how to retire. And you'll fall into this boat of max out 401k, max it out, max it out. But what if you want to retire early, like 53, and all your money's in a 401k? Well, you don't really have an option unless you want to pay crazy taxes and penalties. Or what if you want to retire early and you don't want to have to pay $20,000 a year in healthcare premiums? This person, if John were to hypothetically retire tomorrow, he's 55, he can use the rule of 55 to start withdrawing from this 401k. But what's the risk? The risk is he's going to have to pay for healthcare premiums at a significant rate. Why? He doesn't have a way to massage his income. He's pulling money from his 401k, which is taxed as ordinary income. What if he had a brokerage account? And a brokerage account, or what I call a superhero account, allows you to invest. There's no limit. You don't get a deduction when you put money in, but there's no limit. And the coolest thing is when you pull money out, the gains are taxed on a different schedule. They are taxed on capital gains rates, not ordinary income rates, which are much higher. Capital gains rates are 0%, 15%, or 20%. So how cool would it be if we could pay literally 0% taxes and get healthcare premiums and save on that? I mean, how awesome would that be? And then do Roth conversions later. I mean, that's generally what most people are like, yeah, I think I need to do that. So let me start with the example that I think is going to blow your mind. But before I do, a reminder, my name is Ari. I make videos on tax strategy, healthcare, estate planning, withdrawal rates, and I love it. Now, one thing I'm not going to go over today is how do you actually invest inside of your superhero account? If that's what you want, search this, how to invest superhero Ari Taublieb. It should come up. Here's a video where I literally go over how you should invest inside of that account. That's not the topic for today's video. I'm going to show you why this is so important. You might want to check that out after. Now, I'm a CFP, a certified financial planner, host of the Early Retirement Podcast, and Chief Growth Officer here at Root. Let's have some fun. So watch what I built for you guys. I just could not wait to show you this. Okay, so here's someone. They've got a home worth 1.4, a loan of 300,000 or so. They've got nearly 2 million in investments. This says 3 million here because it's taking net worth. Look at what I built here. I'm going to show you a hypothetical, but for now I want you to watch this. Okay, $1.9 million. If we go to the retirement tab and we're going to assume they want to spend 10 a month, retire in 5 years, vacations, new cars, pay for kids' college, all that stuff, which we can all look at later. If we just go to their plan, we want to know, okay, what's the ending balance? How much money would we end with if this was our portfolio? And this is the number I need you to remember, $443,000. Here we are, we're 54, we work till 60, then we're spending. Now, what could they do? Well, they could obviously be like, we don't need to spend 10,000 a month, we can spend 5 a month, and then the plan will look way better. And if you want to use this tool, this is available in the description below, so you can get it. But you can see if we put this back to 10,000 a month, because that's what they want to spend 10 a month, that's 120 a year plus 25,000 for the first 10 years. That's $145,000 a year. Some of you are like, I don't know how I could spend that amount. Others of you are like, that's it. So no right or wrong. No right or wrong. Just make sure you are planning for your retirement. Now, here's what I want to show you. What was the number to remember? 443. Ready? Watch this. What if instead of having 1.9 million in their 401k, I'm going to take 500k off? OMG, what am I doing? I'm taking that off right away. So they just lost 500k, but I'm going to put the 500k back on. Here it is. I just excluded it from their plan. So now I'm just going to put it back on. So what did I do? All I did is I said, imagine instead of having 1.9 in a 401k, along the way, when they were offered the chance to max out their 401k, they said, you know what? Rather than max it out, we're still going to get the free match. We want the company match. We love free money. But any additional amounts, we're going to start putting that into this superhero account because some guy on YouTube says it might make sense. What amount do you think it's going to show? Remember, the dollar amount didn't change. We still have 1.96. That has not shifted. But remember what it said before? It said 433. Well, now it says almost $1 million. What's the reason for that difference? It's not what you think. What some of you are thinking right now is, well, the reason for that is pretty clear because they're going to have to pay taxes on the 401k when they take it out. But what you're not accounting for, Ari, you're failing to see that those dollars that are now in this hypothetical in a brokerage account, these we didn't get a deduction for. So my 401k would theoretically be higher because I got a deduction which allowed me to do other things with those dollars. You're correct. And what those other things are often spending. So here's my favorite example. Okay, so I had a client come to me, and I'm going to connect the dots, I promise. And they said, Ari, I want to turn on Social Security early because I think if I turn it on at 62, what I'm going to do is I'm going to take that money and instead of having Social Security invested, I'm going to invest it. Because I read online, they grow it at like 5.5% from 62 to 67, my full retirement age, and then 8% or so from 67 to 70. And I think I'm better than that. So rather than rely on 5.5% growth of Social Security, I'm going to collect it and I'm going to invest it. And I was early on in my career. I'm like, that sounds right to me. Okay, if you feel that way, you know, S&P 500 does 10% on average. That's okay. What do we think? And what happened is they didn't save and invest it. They spent it. So maybe if they did invest it, they would have gotten 10%, but they didn't. So why do I bring this up? What I find with the math, when you have your paycheck and you're wondering, okay, here's my gross paycheck, here's my net. When you go update something, what happens to the brain is you're like, I'm left with a certain amount of dollars. That's what I have to spend. If you were given $10,000 that you knew was going to vanish if you didn't spend it, you'd find a way to spend it. So the reason I bring this up is you'll add more money along the way to your plan, I promise, if you are saying, you know what, I'm going to set it up on an automated schedule. I'm going to max out my 401k at 5% now that I have a healthy amount in my 401k, and I'm going to defer extra amounts to my brokerage account, and I'm going to do that for X amount of years until I retire, because that way you have more flexibility. Now, make sure you're invested the right way in the superhero account. But the 401k, this is something a lot of people fall in the trap of because they're like, I'm just going to keep maxing it out and I'm saving. I get a deduction. It saves me on taxes today. And who doesn't want to save on taxes? I'm all about being patriotic, but there becomes a point where I want to make sure you're also not sacrificing you and your long-term goals here. So with this superhero account, why is this so powerful? Well, it allows you to keep your income low and qualify for healthcare subsidies, which might legitimately be $15,000, $10,000, $20,000 a year in savings, which if this person retires early could be literally worth $100,000 from 60 to 65. At the same time, it allows you to pay for the Roth conversion taxes. So what the heck does that mean? Well, if this person wants to do Roth conversions because they are like, wow, I'm going to have these big distributions in the future. What the heck do I do about that? Well, when you pay for those taxes, you need to use some money. If you were to go ahead and just do that with your 401k, that's just bumping you to a higher bracket, which means you're paying conversions at a higher rate. So it might make more sense in this case to go, wow, what if I use some of my superhero dollars, live off of those in the early years of my retirement, so when I convert money, I'm converting it at 10% or 12 or 22%, which essentially, I just said essentially, which is not a word, essentially makes your Roth conversions way more effective. So this superhero account, there's so many benefits. I have so many videos talking about it. But in this hypothetical here, what I am showing is I'm assuming that this person was living within their means, and they essentially set up an automation so that when they did receive their paycheck, they ended with X dollars, and they automatically move dollars into this brokerage account. Because if you don't set that up automated, what happens is you just end up spending it because you're a human, you're not a robot. But if you are more diligent and you are willing to set up that automation, just like your money goes to your 401k today, you don't have to deal with anything. Well, then you have a chance for significant success here. So here's someone that now is on track for $1 million because they have a brokerage account. They can control how they massage their income. They can get creative. Now, I'm not saying you would have this opportunity, but I am saying, and I recommend, go play around with this tool. This is the little trick that I did to show my client this. So what you need to do first to compare it apples to apples is don't include it in the plan. So you need to have your 401k be the true balance here, and then you can hypothetically show, well, what if I had a brokerage account? Some of you are going to beat yourself up. You're going to be like, oh, why didn't I have a brokerage account? Don't beat yourself up. Okay, no matter when you learn about these strategies, you can put yourself in a better spot. So if you want to use this tool, it's available below. If you want to work with Root because you want our help on optimizing all of this, because it does get complicated very quickly. If you can't tell, we love getting to do it. Superhero accounts, it totally depends on the cost basis. So if you bought something for $5,000 and now it's worth $500,000, that's going to show very different value on the software if you bought something for $300,000 and it's worth $500,000, because now we have a smaller gain, which means that, once again, when it looks at principal, pretend, just hypothetically, you want to spend $100,000 in retirement, and you have, let's say, a brokerage account, and it's worth $120,000. Actually, let's say it's also worth $100,000. So you want to spend $100,000 a year, first year in retirement, and you have a brokerage account worth $100,000. And let's say $80,000 of it is your cost basis, and $20,000 are gains. Well, if that's you in this scenario, $80,000 you take, you don't pay any taxes. It's already been taxed. That's your principal. The additional $20,000, that's what you pay capital gains rates on. If you guys don't already have this, this is in my academy, but I have what's called an important numbers sheet. This is going to connect the dots for your entire retirement. So I certainly encourage you, whether it's taking a screenshot of this or just having it on hand, you can see here, it's all in the academy with more flowcharts like this. The first 10%, 12, 22, they're all taxed on this schedule here. So once again, if you were to, let's say, spend $200,000 in retirement, which we have clients that do that, you could see you'd be $6,700 away from filling up the 22% bracket, assuming you're married filing jointly. Now assume you want to do Roth conversions also. Okay, well now you're going to be doing those at these rates up here, which is not as fun. But if you had a superhero account and you pulled, let's say, $100,000, of which $20,000 are gains, you could see here, of those gains, the first $96,700 taxed 0%. So that means you could pull $20,000, pay no taxes on it, and that's $76,000 left over that you could realize in gains. But at this point, hypothetically, you only have $100K in the superhero. So now you might start doing Roth conversions as an example and paying at these brackets way down here versus paying way up here. So I know I went through a lot today. Obviously, I love this stuff because I'm a nerd that likes this stuff and finds it cool. If you're like, wow, I equally find it cool, awesome. If you're like, you're losing me here, there's so much that I try to explain, so I apologize if I got lost in the weeds today, but I truly do love it. So that's all I got for you for this video. See you guys next time.